Hi, Garrett. Just going to take you through a little bit of the paper here. I'm not going to focus on the section A stuff because it's fairly straightforward, so you can have a look through. I don't think there's too many complicated things in there that I've any questions about, but really, in section B, I have got the first question, which is a lease. Things I'm interested in are that I have an option at the end to extend the lease. So again, and I've got an upfront payment. So in the new IFRS 16, the upfront payment will be included in the asset but not in the liability. And the option to extend then should also be included in the liability. And then it's just standard how they treat that. So again, it's whether those complicating factors should be included. For the second one, okay, so this was the EPS one, and it's all fairly standard, but there's lots of stuff in it. So in the basic, I've got a bonus issue and a rights issue, and in the diluted, I've got the convertible and I've got some options. It's just whether that's too much. Now, I did look at the questions they get in class and past paper questions. I think they can deal with all of this. It's just whether there's too much. And then again, if they have practiced this and done those questions, they should be able to deal with it. It's just, again, is it too much? The third part then is deferred tax. Again, pretty standard. I haven't actually put in the figures here because I just wanted to check this stuff first. And the only one I think could be an issue is this, which is some losses carried forward. The rest of this stuff is all standard from past paper questions and class questions, etc. It seems reasonable to me, but it's just whether that first one is too much or if that is okay. Into the question 4, issue 1. So yeah, this is self-constructed asset, but I've focused solely on IAS 23, the borrowing costs, actually right down to there, and I've given them two loans which should be treated in slightly different ways because they've got a different rate and there's some temporary investment income. So I felt that that was, complicated enough for them not to then need the other construction costs. But again, it's whether that's maybe not what you had envisaged. And then two government grants. So again, they've got this one for labour, which should be over the 3 years of the build, and then this one is an underground heat pump, which should be over the useful economic life. I suppose I've asked them how to treat, I've given the journal entries, and they could do deferred income on that one, or they could net it off the net book value of the asset. So I presume we can just say we'd accept either treatment. Again, just wanted to check that with you. In issue 2, yeah, so share appreciation rights, but again, I see a lot of standard questions here, and that's fine. I can still do that. I just wanted to throw in something slightly out of left field, and what I did was I did share appreciation rights, so it's cash settled, but I allowed them to take up the appreciation rights if the share price hit a certain amount, which it does here, and some managers do take it up, so they'll have to create the liability in the first year. They'll have to understand then that at that point where it reaches 34, then some of those managers can take up the rights, how they would take those up, reducing the liability. And then we've got the year end amount here. So it's just whether that again is too much, whether I should standardize that a little bit or if that's okay. Then the last one is, yeah, I felt fairly straightforward if they knew their stuff on IFRS 9. Two bonds, financial instruments, one of which is held for trading, which is the second one, and one of which is going to be amortized cost held to maturity. So essentially I've just given them fairly standard information and asked them for discussion of how they should be treated and classified, and then impact in profit and loss and the carrying value to the year end. So again, it is just a draft. I haven't drafted up the answers to this part of the paper. I just wanted to check about the level, etc. again, like we did last time, just to make sure that we're pitching this at that correct level.